Hello, and welcome back to my channel, The Midlands Investor, your one-stop shop for all things investing and personal finance. A Random Walk Down Wall Street is a finance book that provides a comprehensive and accessible guide to the world of investing. Written by Burton Malkiel, a Princeton economist and investment advisor, the book was first published in 1973 and has since become a classic reference for investors and finance professionals. Malkiel is a renowned economist who has made significant contributions to the field of finance, including his work on the efficient market hypothesis. The book offers practical advice combined with rigorous analysis of the stock market, making it a go-to reference for anyone looking to understand how to invest their money wisely. The author's background and credentials are central to the book's credibility and popularity. The author holds a PhD in economics from Princeton University and has been a professor of economics at Princeton, as well as a visiting professor at several other prestigious universities. He has also served as a director of the Council of Economic Advisors and as a member of the US Securities and Exchange Commission's Economic Advisory Panel. The book's success can also be attributed to several other key factors. First, Malkiel presents complex financial concepts in an accessible and easy to understand manner, making it appealing to both seasoned investors and beginners. Second, the book debunks the myth of stock market prediction and provides a compelling argument for investing in a diversified portfolio of low-cost index funds. Third, the book's practical advice and rigorous analysis have made it into a trusted reference for investors and financial professionals, who continue to refer to it decades after its initial publication. So without further ado, let's dive into the main body of the text. The first key concept is the efficient market hypothesis. The efficient market hypothesis, or EMH, is one of the central themes in Malkiel's book. The hypothesis suggests that stock prices reflect all publicly available information and that it is impossible to consistently achieve above average returns by using this information. According to the EMH, stock prices reflect all known information, and any new information that arises is immediately reflected in the stock price. Therefore, it is impossible to consistently achieve above average returns by using this information since the market has already incorporated it into the price of the stocks. Malkiel argues that the EMH is supported by empirical evidence, and that investors who believe they can outsmart the market by predicting future stock prices are misguided. He supports his argument by referencing studies that have shown that professional fund managers, who are paid to outperform the market, have not been able to consistently achieve this goal. This is because the market is efficient, and any new information that arises is immediately incorporated into the stock price, making it difficult to gain an advantage over other investors. Takeaway number 2. Random walk theory. Malkiel also introduces the concept of the random walk theory in the book. This theory suggests that stock prices follow a random path and that it is impossible to consistently predict the direction of the stock market. The theory is based on the idea that stock prices are influenced by a variety of factors, including economic data, company earnings, and news events, which are all difficult to predict. He goes on to argue that investors who attempt to predict the stock market are essentially gambling, since there is no way to consistently predict the direction of the market. Instead, he advocates for investing in a diversified portfolio of low-cost index funds, which allows investors to benefit from the long-term growth of the stock market without trying to outsmart it. Takeaway number 3. Technical analysis. Malkiel also covers the topic of technical analysis in the book, which refers to the practice of using historical stock price data to predict future stock prices. Technical analysts believe that patterns in stock prices can produce clues about future price movements, and they use charts and graphs to identify these patterns. Malkiel argues that technical analysis is flawed because it relies on the assumption that historical patterns will repeat in the future, which is not always the case. He suggests that technical analysis is essentially reading tea leaves, and that investors who rely on this approach are not likely to achieve consistent success in the stock market. Instead, he advocates for fundamental analysis, which involves analysing a company's financial statements, earnings, and other qualitative factors to determine its true value. Fundamental analysis is more reliable than technical analysis, as it is based on concrete financial data and can provide a more accurate picture of a company's financial health. Takeaway number 4, diversification. Another key concept in the author's book is diversification, which refers to the practice of spreading your investments across a variety of different asset classes to minimise risk. Malkiel argues that diversification is essential to achieving long-term investment success, as it helps to minimise the impact of individual stocks or asset classes on your overall portfolio. Malkiel suggests that investors should consider investing in a diversified portfolio of low-cost index funds, which provide exposure to a broad range of asset classes at a low cost. This approach allows investors to benefit from the long-term growth of the stock market without taking on excessive risk. Takeaway number 5, active versus passive investing. Malkiel also addresses the debate between active and passive investing in the book. Active investing refers to the practice of trying to beat the market by picking individual stocks or timing the market. Passive investing, on the other hand, involves investing in a diversified portfolio of low-cost index funds and holding them for the long term. Malkiel argues that active investing is generally not a wise approach, as it is difficult to consistently outperform the market. Instead, he suggests that investors should focus on passive investing, which is a more reliable and cost-effective approach to investing. A Random Walk Down Wall Street is a timeless investment classic that provides valuable insights into the world of investing. The author's rigorous analysis and practical advice have made the book a trusted reference for investors and financial professionals, who continue to refer to it decades after its initial publication. The book's central message is that investors should adopt a long-term approach to investing and should focus on investing in a diversified portfolio of low-cost index funds. By following this approach, investors can benefit from the long-term growth of the stock market without trying to outsmart it. Overall, A Random Walk Down Wall Street is an essential read for anyone looking to understand how to invest their money wisely. The book's practical advice and rigorous analysis provide a solid foundation for anyone looking to achieve long-term investment success. And that's it. Thank you for watching. I've been the Midlands Investor. Don't forget to like and subscribe if you enjoyed this content, and I'll see you again next time.